Tonight, you're going to scroll past a headline about gold hitting another record high, and you're going to keep scrolling. It barely registers anymore. Gold going up again feels like weather, background noise, something that happens to other people's portfolios, not your life. Maybe you've seen the numbers so many times by now that it's stopped meaning anything at all, just another figure climbing in the corner of a financial app you don't really check. But this rally isn't ordinary weather. It's one of the strangest financial stories happening right now, and almost nobody around you can actually explain why it's happening. Tonight you will. Here's the shape of it. In numbers first. Gold started 2026 trading somewhere around $2,600 an ounce. Within weeks it had blown past 4,600. By late January it crossed 5,000, then kept climbing toward 5,500. That is not a typical year for gold. That's not even a typical decade. Silver, meanwhile, more than doubled over the same stretch, and platinum and palladium joined the surge too. This isn't one metal having a moment. It's the entire precious metals market screaming the same thing at once. So what is it screaming? To understand that, you need to understand what gold actually is, underneath the shine. Gold doesn't pay you interest. It doesn't pay a dividend. It just sits there, inert, doing nothing productive at all. For most of modern financial history, that made it a fairly boring asset, something you held a little of and mostly ignored. So when an asset that does nothing suddenly becomes the most talked about trade on the planet, that tells you something important isn't about gold at all. It's about everything gold is being compared to. Start with interest rates. Through 2025, the Federal Reserve cut rates repeatedly, bringing them down from restrictive highs toward the mid 3% range, with markets pricing in further cuts through 2026. Here's why that matters for gold specifically. When interest rates are high, holding cash or bonds pays you something. Gold, which pays nothing, looks relatively unattractive by comparison. But when rates fall, that gap narrows. The opportunity cost of holding a shiny, non-yielding metal instead of an interest-bearing account shrinks. Suddenly, gold isn't competing at a disadvantage anymore. Layer on top of that a weakening US dollar. The dollar index fell sharply through the end of 2025 and into 2026, and a weaker dollar makes gold, which is priced in dollars, cheaper for buyers overseas. Cheaper prices for international buyers mean more international buying. More buying means higher prices. It's a feedback loop, and once it starts running, it tends to keep running. Now add the part that doesn't show up neatly on a chart. Fear. Not abstract fear. Specific fear. Geopolitical tension escalated sharply through early 2026, including tariff threats and military conflict that rattled markets and sent investors looking for something that couldn't be frozen, sanctioned, defaulted on, or devalued by a single government's decision. Gold has one property almost nothing else in the financial system has. It isn't anyone's liability. It doesn't depend on a bank staying solvent or a government keeping its promises. When you hold physical gold, you're not trusting anyone. That single property is why central banks have been buying gold too, and not just for tradition's sake. Poland's central bank, for instance, expanded its gold reserves specifically to reinforce confidence in its own currency amid regional instability. Multiple governments have quietly done the same, treating gold as insurance against a financial system they no longer fully trust to behave predictably. This isn't a new instinct exactly. Central banks have held gold reserves for generations. What's different now is the pace and the reasoning. This wave of buying isn't about tradition or ceremony. It's about diversification away from a small handful of currencies that used to feel unquestionably safe and increasingly don't. Total global gold demand crossed 5,000 tons in a single year for the first time ever, according to World Gold Council figures, representing hundreds of billions of dollars in value and a sharp jump from the year before. That's not a niche market movement. That's one of the largest coordinated shifts in how the world stores value that's happened in decades, and it's been building quietly, mostly outside the headlines that actually get people's attention. Here's the counterintuitive twist, though, the part that should genuinely surprise you. This rally isn't just central banks and cautious institutions anymore. According to the World Gold Council, global investment demand for gold hit records through 2025, with investors pouring roughly $89 billion into gold-backed funds in a single year, the largest annual inflow ever recorded. Physical gold ETF holdings roughly doubled. Ordinary retail investors, not just sovereign wealth funds, piled in through bars, coins, and exchange-traded funds. And more recently, a new kind of buyer has shown up entirely. Cryptocurrency investors, some of them treating gold the same way they treat Bitcoin, as a hedge against the very financial system both assets sit outside of. This is a genuinely strange alliance if you think about it. For years, gold and crypto were often framed as competitors, two very different bets. on what money should look like without a government standing behind it. One is thousands of years old and physical. The other is barely more than a decade old and exists only as code. Now, in this particular moment, both are being bought by overlapping groups of people for strikingly similar reasons, a sign of just how widespread the underlying unease has actually become. Fear of missing out has amplified the effect further, with smaller retail investors piling into the trade simply because everyone around them seems to be doing it too, which can push prices even higher in the short term, regardless of the underlying fundamentals. There's also a much stranger, more human thread running underneath all of this, especially in India, where gold has always carried a cultural weight far beyond its market price. As gold prices climbed, more people started using their gold jewelry as loan collateral rather than selling it outright, pledging it through formal lending channels to raise cash while still holding on to the asset itself, and in many cases still keeping the emotional and cultural value attached to a piece passed down through a family. The World Gold Council estimates that well over 200 tons of gold jewelry have been pledged this way through formal lenders in a single year. This has quietly reduced the amount of gold flowing back into the market for resale, tightening supply even further and adding more upward pressure on price. It's a small, human-scale decision, repeated across millions of households, that's actually shaping a global market, and it carries its own quiet risk too. If economic conditions weaken sharply and people can't repay those loans, pledged gold could flood back onto the market all at once, reversing the very tightness that's been propping prices up. So notice what's actually happening here. None of these forces are really about gold. They're about trust. Trust in interest rates staying low enough to make cash unattractive. Trust in the dollar holding its value. Trust in governments not escalating conflicts further. Trust in a financial system that, increasingly, in the eyes of a growing number of investors, doesn't fully deserve it. Gold isn't going up because gold got more valuable. Gold is going up because everything else is starting to look a little less certain, and gold is one of the only things in the financial world that was specifically designed, thousands of years ago, to hold value when human institutions can't be relied on to. This is where it connects back to you, scrolling past that headline without a second thought. You may not own an ounce of gold, most people don't. But the reasons driving this rally are the same reasons sitting underneath your own financial anxiety, even if you've never put a name to them. The same falling interest rates nudging investors into gold are the ones affecting your savings account, yield quietly making that account pay you less than it used to for doing nothing. The same weakening dollar making gold cheaper overseas is quietly making everything you buy from abroad more expensive, from electronics to imported groceries. The same geopolitical tension pushing central banks to stockpile bullion is the same tension you feel, vaguely, every time you open the news and see another headline about conflict or tariffs you don't fully understand but somehow still feel. Gold's price chart is, in a strange way, a live readout of collective anxiety. Every time it spikes, it's measuring something real, some erosion of confidence happening somewhere in the system, whether that's rate policy, currency strength, or the stability of the world order itself. You don't need to buy an ounce to be affected by what that chart is telling you. If gold is climbing because trust in fiat currencies is eroding, and you hold your savings entirely in fiat currency, that chart is quietly describing something happening to your money too, whether you've noticed it or not. Here's what's genuinely uncertain going forward. Not everyone agrees this continues. Some analysts point out that gold pays no yield and no dividend, meaning if inflation cools, if rates stop falling, or if geopolitical tensions ease, some of these gains could reverse quickly. Markets have already seen sharp pullbacks even within this rally, reminders that momentum can run in both directions just as easily as it climbs. Others believe the structural shifts, central bank diversification, a genuinely weaker dollar era, a less trusted global financial order, are here to stay regardless of short-term swings, arguing that this rally reflects something deeper than a passing trade. Nobody knows for certain which view is right. That uncertainty is, itself, part of the story. It may be the most honest thing anyone can tell you about where gold goes from here. Tonight, you'll probably scroll past another headline about gold hitting a fresh high, or pulling back sharply from one. Either way, you'll likely keep scrolling. But now you know what that number is actually measuring. Not just a metal getting more expensive, a quiet global vote of no confidence, cast in bullion, by investors, central banks, and ordinary savers alike, all reaching for one of the only things in the financial system that answers to no one.